Welcome to video 3C on timing and taxes. For those of you that mastered present value and taxes in the previous video, you may find this one a bit redundant, as we're going to continue to invoke those same concepts here, but in more complex ways. But we do not really cover a lot of new territory, just more practice on more difficult transactions. In the previous video, we learned that the time value of money affects the after-tax value of our cash flows. And we also learned that rate can affect the after-tax outcomes as well. And just to reiterate, we generally prefer higher inflows and lower outflows. We reviewed the present value formula, but a better solution is the present value tables, and these are widely available on the internet. There's one for the present value of $1 and a different one for the present value of an annuity. But I will tell you that your best bet is just to get a calculator that does the financial calculations for you. I don't really care how you compute present value, but I will tell you that calculators are the fastest. Let's start our timing strategy with a non-tax example. At a recent holiday sale, SpongeBob purchased $1,000 worth of furniture with no money down and no payments for 1 year. So how much money is this deal really worth if we assume SpongeBob's after-tax rate of return is 10%? Well, we can determine what is the present value of $1,000 a year from now. And you can see that it's $909. So by waiting to pay for this with no money down and no interest, SpongeBob is going to save $91 by waiting to pay for this furniture for a year. Hopefully that makes sense, especially since our last video, we did a tax-based example. And we saw how the present value of money affects after-tax cash flows. We can also examine how changing rates affect our after-tax outcomes when they're combined with timing. So in this case, Chum Bucket Corporation can deduct $1,000 this year or next year by paying on the last day or the first day. So in 2017, the tax rate's 35%, but in 2018, the tax rate is 21%. So now there are two components that affect the outcome of this analysis: timing and rate. So if they pay this in 2017, the pre-tax outflow is $1,000. The tax savings is $350, which means the after-tax cash flow is $650 outflow. The present value of that is $650 because there's no difference. If, on the other hand, this gets paid in 2018, now the deduction is only worth 21%, or $210. The after-tax cash flow is $790. But since the tax savings gets reduced due to present value, the after-tax outflow is $800. So in this case, choice 1 totally crushes choice 2 because the combination of tax rate and present value of money effects. That brings us to our two basic tax-related timing strategies. The first one is accelerate deductions, and the second one is defer income.
Learn it, know it, live it.
So when tax rates are decreasing, taxpayers should accelerate deductions in the earlier years and defer taxable income to later years. And we already know why, because we just did an example of this. Accelerating deductions maximizes the present value of tax savings. And that's done in the earlier years with the higher tax rate. Deferring income minimizes the present value of taxes that have to be paid due to the deferral of income to later years with a lower tax rate. So when tax rates are decreasing, our general rule of accelerate deductions and defer income applies perfectly well. If, on the other hand, tax rates are increasing, then the taxpayer needs to calculate the optimal tax strategy for deductions in income. The reason for this is now the taxpayer needs to calculate whether the benefit of accelerating the deduction is going to outweigh the disadvantage of recognizing a deduction in a lower rate tax year. Same with deferring income. Is the benefit of deferring income going to be outweighed by the disadvantage of recognizing income in a future higher rate tax year? So let's take an example. Chum Bucket has decided that they need to buy new equipment, and they're considering whether to make a $10,000 deduction for the purchase of equipment this year or next year. And Plankton anticipates with the new machinery, his business income will rise so that his marginal rate will increase from 20 to 28%. So if we assume the after-tax rate of return is 8%, what should Plankton do? Well, if the furniture is paid for and deducted in December, it'll be $10,000 times 20% tax rate, or $2,000. If, on the other hand, they pay it in January, then it's $10,000 times 28%, or $2,800 of tax savings. But then, of course, we need to discount that back. Discounting that savings back means that the present value of that savings is only $2,593. But either way, that's still bigger. And so for sure, Plankton should pay the $10,000 in January. If we change the increase in the tax rate to only 1%, so it went from 20% to 21%, now the increase in the tax savings is up to $2,100, is going to be totally subsumed by the loss of value on the dollars by waiting a year for the deduction, as the present value of the $2,100 tax savings would only be $1,944. In that situation, you'd actually want to pay it now. There are a few limitations to the timing strategy. The first is, generally, a deduction is not available without a cash outflow. And so, basically, you got to make sure you have the cash to make the payment. On the income side, to defer the income, you must somehow not close the transaction. By doing so, the taxpayer is going to remain at risk. For example, by not selling a stock, but then the price goes down. Lastly, the constructive receipt doctrine does not always permit a taxpayer to turn their back on income. And we're going to cover that more in Chapter 5 next week.